everybody, welcome back to Exponential Finance, the podcast covering finance, technology and innovation, from our home in Japan and beyond. We wish you a very happy year 2021, please stay healthy and in good spirits. Mouro Capital is a venture capital firm with $400 million assets under management that targets early-to-growth fintech investment opportunities across Europe, North America, and Latin America. Manuel Silva Martinez oversees Mouro's strategy, investor relations, resources and processes as the general partner authorized by the FCA, with his day-to-day investment activity focusing more on UK, Europe and Latin America. Manuel sits on the boards of A55, Bonify and Crosslend and, as observer, of Autofi, Creditas, Curve, Elliptic, Klar, Roostify, and Tradeshift, among others. Manuel has been investing in fintech since 2010, having spent 5 years in San Francisco with BBVA Ventures, now Propel VC, before moving to London in 2015. He is a hiking enthusiast, world traveler and wine aficionado. And now, please welcome Manuel Silva Martinez, General Partner at Mouro Capital.
Hi Manuel, how are you?
Yeah, good. How are you doing?
Good. I mean, last time we saw each other, that was right after Money 2020 in Las Vegas. Came over in 2019. And I remember vividly, I asked you, what did you see that was interesting, exciting in Las Vegas? And you were pretty cold on that. You didn't really find much excitement there. Have you seen new things popping up now?
I think it's coming. I think there will be new things in the new year. Not that much pandemic related, although I think that the concept of health is going to be somehow taking a different dimension, I would say, in health and planning and all that. But I think there will be more stuff related to the way people organize work, the way people consume. I have a hard time believing that we're going to go back to a normal life like it was like 18 months ago. And so basically it's, whoever is able to identify that and build for that, I think they're in a good position.
The other thing that changed obviously is evolution from Santander InnoVentures to Mouro Capital. So from a corporate VC to a standalone VC with Santander as a limited partner. Was that part of the long-term plan already, or is it something that triggered it internally?
Yeah, when we met in Tokyo, actually, it was already approved. This is like centuries ago. And it has just taken a lot of time to get all the paperwork done. We had to get our own license. We had to get just the basis for operations under the new scheme. So that took a long time. That has been in the planning for a while. It's actually not COVID related. If you ask me, COVID has helped a little bit, not from the perspective of the approvals, but more from the perspective of if I had been traveling like I used to, it wouldn't have happened, in the sense that being locked in a desk with the 24 hours of your day ahead of you to just work on paperwork has been a little bit of a great thing to some extent, as annoying as it may sound.
How does that change what you're investing in or the industry's business lines that you're looking at from an investment perspective?
I don't think it changes dramatically. I think at the end of the day, we've always kept a very open lens as to where the future of the industry is going. And, as opposed to maybe other corporate VCs that are very dogmatic about, you need a commercial engagement with every single company and, you cannot really invest if you don't have a business sponsor and stuff like that. I think what this does is it takes that to the next level, if you will. Now we're financial return first, meaning right now we want to be in the best possible companies and we want to make them as successful as they can. And that is kind of the premise across the portfolio. And then in certain cases, there will be interest in those companies working with our LP, and then we'll facilitate that to some extent, right? So I guess how that changes is that probably it opens up our investment lens to things that are slightly more forward-looking and slightly more defining of where we think the industry is going, as opposed to maybe things that have more of a short-term application, although we still look at those. So it hasn't been a replacement, if you will, of the investment strategy. It has been an enhancement, if anything.
Does it make it broader in certain aspect? I think I saw on your website, enterprise software. Was that previously a part of it too, or is that one step further now in broadening out a bit more?
It's really kind of both, interestingly. You can think it's a little bit new because it's not technically fintech, right? But now if you think about kind of the way financial services are being more and more embedded into other experiences, and if you think also about how a lot of banks are thinking about themselves more as a back-end infrastructure and API delivered products and things like that, We see that there's a very interesting angle whereby if we expand into SaaS, you can, on the one side, tap into businesses that are going to be growing. And I think, if you relate that to COVID, I think COVID is a booster for anything SaaS. And then on the other side, you can create interesting alliances whereby you invest in a platform that does something that has nothing to do with financial services, but you need a payment, you may need a lending piece behind it, you may need some sort of other complex process, identity verification, things like that. And so at the end of the day, to the extent that you can connect a bank or Santander in our case with those processes and create some business there, that can be interesting.
The fintech story has almost changed from building for the consumer to building for developers and building all the APIs and making the service available in a B2B2C model much more so than going directly to consumer.
The thing is, there's been a little bit of a pull effect, I think, on fintech. If you go back to financial services 7-10 years ago, when I started investing, it was very much about let's create a new brand, let's do something that banks are doing better. It was very focused on the assumption that there's a latent demand by customers that is not fulfilled. I think that principle remains true, but I think now the ones who are dictating how that demand is shaped up are not the users anymore. But to your point, it's more of a B2B approach where you can have other companies that don't necessarily have a fintech product per se. It's not a financial service, but there's an underlying utility that banking can create or should create or needs to create. And then they're the ones who come to you and say, well, I need a payment API and your API needs to be great. And I need a lending solution and it needs to be delivered at the point of purchase. And to your point, I think the pressure to develop back-end technologies that support those things is much higher than it used to be. Maybe the fintech paradigm has changed a little bit in that regard, but it has been as a change in the demands.
And in that context, how do you view, for example, the Google Citibank or the Apple Goldman relationships?
Well, it's interesting, right? Because I think that shows one hypothesis that we've had for a long, long time, which is that the boundaries of the industry are getting blurrier and blurrier. Especially if you look at it from the back end, as we're just discussing, it's really hard to make a clear cut of what is a financial services product, what is some other utility. And so those alliances are just the reflection that at some point, it's all about getting the resources together and thinking about what customers will need more than anything else, right? So I would expect to see much more of that. And I would expect to see even more, I would say, diverse players to come into play. Clients are demanding new things. And at the end of the day, it's more about how do we partner to get that done, right? But it's really interesting, right? Because some of these recent developments where you have, large banks working with large tech companies, you have the larger fintechs behaving more and more like large banks. So you see, what Stripe is doing, you see what Square is doing. I mean, they're behaving like banks now. And then also you have banks trying to be more and more like startups, spinning out second brands of direct banks and new lenders and stuff like that. It's really interesting how basically what was a very clear battlefield in a way, 3, 4, 5 years ago, where you would say, well, you have the techs, the banks, and they need to figure out how to compete with each other. And then you have the fintechs, which are the eternal promise, but it's not really sure they're going to be big enough. Now it's basically it's kind of all over the place in a way. And I think that's really interesting. And that makes our life as investors really hard because it's one thing to try and identify big consumer trends and big technology trends that are going to change the industry. But then on top of that, if you need to overlay, massive competitive changes that are happening quite quickly, and then you're investing for the long term, how do I get it right in a way, right? And how is the idea of the team that I'm investing today, how are they going to be equally capable to survive all of that and still make a big business, right? So it's really tough. But anyway, nobody said it was going to be easy.
Your colleague wrote an interesting piece about selling the picks and shovels to the gold rush. That would maybe be the natural response to what you just said. It's great if everybody goes to California and digs for gold. We just sell them the shovels, but that had some limitations that were highlighted. Can you share some of that as well?
It all becomes an enabler game, right? It all becomes a back-end game. Then you're also reducing the revenue pools that are associated with payments, with lending, with infrastructure, et cetera, et cetera. As much as today it's easier to build a business, it's cheaper to build a business. At COVID, you don't need offices anymore. You can have better labor cost arbitrage because you can have your team remotely and it doesn't really matter anymore. I think there's limitations of the hyper competitivity. And so at the end of the day, if everybody's competing for the marginal interchange rate and everybody is competing for, smaller and smaller economics, I think there needs to be also new businesses being built in a way that bring back intrinsic novel value. The backend game has the danger in a way of being just a replacement, a better replacement of the old stuff. And I think there needs to be like new stuff built on that, which, I think will come as well. I mean, as of now, I think most of the things that we're seeing that are new are not that new. I mean, they're like a better version of something old. But my hope is that there's going to be new, not only old new or renewed old, but also new. Over history, a lot of things that people used to pay for ended up being free. There's a point where things become free. Things like, water consumption and like spices and like a bunch of things. And I think a lot of that can also be applied to that game now. And so at the end of the day, you can see a world where payments are effectively free. Email is free in a way, and a payment is not very different to sending an email. You need a point of departure, you need a destination, you need some parameters, and you need to make sure that it's safely structured, right? And so at the end of the day, the challenge for entrepreneurs is how do I build that new thing that is still so differentiated that it's very, very far from being free? But it's interesting because even with some of our companies, I mean, I feel that a lot of the discussions we have with them have gone to discuss the longevity of products that they're launching, as opposed to just, this is my product. I'm like, yeah, great. That product is going to last you 2 years. What are you going to build next? They say, well, I haven't even started my first one. I'm like, well, but you need to think about the second one and the third one, the fourth one. Because you know that at some point you're going to get into this race to the bottom thing, and then that product alone is not going to build a big business. But the collection of that and the ecosystem you can build around those products is what's going to build a big company. That's really interesting. That acceleration of the product cycles and how do you have differentiated value for a time, it is moving quite quickly.
And that becomes then a bit of a paradox, because if you want to launch quickly, then you can use your backend service provider that launches you quickly into the market. But if you then want to iterating and be innovative, having new features out, you better build it yourself. But then you need to make the upfront investment. So that's, as an entrepreneur, is a bit of a difficult decision to make.
What we're seeing is that, as you say, a lot of early stage entrepreneurs start on what's available. But then, interestingly enough, the providers of what's available, the long tail API-based products, they also sense that tension when their clients become too big or they become too big of an account. And then, the build versus buy type of thing becomes too much of a tension. And they're starting to adapt to that too. The one thing you don't want is, and there's been a number of, not failures because it's not companies that have failed, but companies that have underwhelmed their own investors, is companies are really successful at the early stage of their clients, and then they have a massive churn where the big account, when the accounts become big, right? And then investors were valuing having massive accounts with those guys, and suddenly, they disappeared. And I think they're also reacting competitively to make sure that they have a value proposition for the early stage, but also a value proposition for the late stage, so that basically they keep the build versus buy answer on the buy side.
What does it mean from the traditional bank side, from your perspective? I think I read a research report, and specifically for Asian banks, payments makes up 50% of their revenue. If we're saying that ultimately moves to zero, and clearly there's a difference between the retail side and the corporate side, but the trend is clear. And then you're in a business where 50% of your revenue is somewhat at risk.
As you say, I think the corporate world is different to the retail world. I think the corporate world, there's so many businesses, and by businesses, I mean, there's so many revenue lines, there's so many products that are attached to complex product streams, whether it's things like FX and reconciliation and anything that has to do with the insurance of those payments and making sure that they get to the destination and they're tied to a trade cycle and stuff like that. So there's so much there that at the end of the day, even if the payment gets reduced to zero from a revenue perspective, you still have all these other services that are actually probably intrinsically more valuable than the pure payment. And so I think that is reasonably protected. Now, the thing is, to your point, on the retail side, it's a little more complicated because at the end of the day, consumers are much less sophisticated, obviously, than corporations. Oftentimes the payment is the sole utility they need from something. You need to pay a service, you need to pay when you get a coffee, and that's all you need. You don't need anything beyond that, right? Because the rest of the utility, the coffee you buy, is produced by somebody who has nothing to do with the payment and doesn't care about the payment. It's a shop. And so at the end of the day, it's how do you create the same dynamics around your payment so that there's something that creates value, intrinsic value, even if your payment component on the retail side still goes to zero, right? And I think that is complicated. I mean, I don't know Asia as well as I know other markets, but from what I've seen, Asia is much more of a platform market than Europe or than the US. And at the end of the day, I think that the fact that in Asia, experiences have been much more online and offline since the beginning, and everything has been much more integrated, and there's much more interest in in loyalty and there's brand awareness and, all these things, that's a good basis to build things on top of the payment rails, right? Whether it's, on the communication side, on the loyalty side, discounts, even, lending is based on that. The bases are actually interesting. I would be more concerned maybe in other markets where you don't have that structure and you don't have those customer habits that have been building over the year and that have created this data-rich environment where you can actually do many more things than just process an anonymous payment. The world of payments is actually one of those where I see that there's going to be more and more disruption. And Asia is also very versed in all the crypto space. That is yet another technological disruption that makes payments free because there's no cost basis anymore, right?
So from the regional perspective, also with the Santander heritage, you're obviously much more active in Middle and South America, which is in turn an area I'm not following that closely. So what does the market look like compared to Europe?
It's an interesting market. It's a market we like a lot because to some extent, if you're an international investor, you have the ability to come to the market with kind of your homework done. And the reason for that is because still a lot of what drives the market are things that have worked elsewhere before or that have been tested elsewhere before. So you as an investor had the chance to observe them maybe 8 years ago in the US and maybe 5 years ago in Europe. And so somehow you know the playbook, you know what works, what doesn't. And then it's a matter of finding what are the local variations of that and how you need to adapt that model to make it successful in the local conditions. It's not as easy as it seems, but at least it's directionally known. And on the other side, the opportunity is massive, right? So Brazil is still a very, very large market and has very high interest rates. So any lender is actually a very compelling value proposition. Mexico, which is the other market where we operate similarly, large market. The proximity to the United States creates also interesting dynamics there, more on the talent side and on the business innovation side. And then there's probably something brewing more at the regional scale where some of the smaller markets that have typically lagged a little bit behind in terms of startup activity and investment, attraction, and stuff like that are starting to emerge as the new places to create companies that have a regional view. A few markets that combined are maybe the size of Mexico or Brazil, right? So I think there's a lot of activity and it's really interesting. But I think it's really, really different from the way we see things in the US or the way we see things in Europe for sure. One of our companies in Brazil, which is a lender, just announced a round last week and they reached unicorn status. And there's a few new unicorns emerging in LATAM this year, last year. You're getting to some of the metrics that you see in more mature markets in a way, but there's still quite a bit of opportunity to be tapped into.
In Mexico, you invested into a neobank, right?
Yeah, we invested in a credit-first neobank. I think the credit-first is important. It's more of a lender that has more of a transactional layer on top of it, which is a model we like more than the traditional neobanks, which are more transactional, and that's kind of it.
So you get the demand side solved first before you get supply side and worry about deposits, while the European neobanks typically just start taking deposits and then they had this money and they needed to start doing something with it.
And I think they come from a different assumption, right? So the European ones were coming from the assumption of universal banking is too complicated and there's people who don't want that. And so if you strip banking from mortgages and investment products, which are very complicated and not everybody likes lending, and then lending is not a great user experience because somehow it's an obligation you have as opposed to an asset you own. So basically they came more from the perspective of let's create simple banking better. And that's why they went to basically accounts with a card and a nice kind of transactional log so you can see where you spend your money and some analytics that are nice and stuff like that. That was the European and the US angle in a way. I think the LATAM one, as you say, the angle they came from is in certain populations, especially the emerging middle class, the younger populations that have historically been not underserved by banks, but maybe they didn't find what they wanted. And then as they get more digital, as they earn more money, as they get into different type of lifestyles, they demand some light touch, low credit lines, stuff like that. And so there was a product to be offered there. And that's where some of the neobanks in Mexico and Brazil have been successful and said, well, I'm going to enable that short-term consumption-driven credit because there's an untapped demand there. And then on top of that, as a way to inform my algorithms, I'm going to create a transactional layer on top of that so I can also understand exactly, how you're spending and then make some money on that. The end product looks reasonably similar in both cases, but I think the entry point to the demand has been quite different.
Very interesting. I feel a bit ambivalent about these buy now, pay later propositions, and one can't argue with the commercial success that these companies had, like Klar in Europe, but it feels like the last thing that we need on the planet is just more credit. Clearly, this can be addictive, and in the same way that some people don't handle alcohol well, some people don't handle shopping well, and it's just the risk of just further indebtedness, which is just not healthy from a financial perspective for the individual.
I mean, I agree to some extent. I think at the end of the day, it's also how those companies build ethics in their own product. And seen companies, especially in emerging markets in the past, where basically you're driving people to the brink of not excessive indebtedness, but there was an abusive ethics behind. Whereas in other cases, I think it's really more of a commerce facilitator, and I think to the extent it remains that, it's not a bad thing. And but it's a little bit like with any lender, right? At the end of the day, you need to see also, what's the ethos behind.
Do you have some bold predictions for 2021?
I think it's still going to be a market that's going to be hard to read. That would be my overarching prediction. And again, that goes back to some of the things I was mentioning around some of the changes in competitive dynamics and some of the bigger guys getting into new categories and just flooding new categories with big businesses and money. I'm also very interested in what's happening on the public market space and all the the IPO waves and all that, which is also creating interesting dynamics on the later stage side for venture-backed companies that probably will also drive companies to want to maybe exit earlier or exit differently. To summarize, I think it's going to be a year of a lot of changes in the competitive dynamics, more so than on the thematic perspective. And then I think from the thematic perspective, the things that are going to be interesting are going to come from the materialization of the changes that COVID has brought to labor, consumption, health, and maybe transportation, and how you organize space, and basically entrepreneurs starting to build for that. All the things that have happened this year can also be a source of opportunity and can also be a source of more better lifestyle choices for people, and then how does that translate into actual products, right?
Super. Thank you very much, Manuel. I really appreciate taking the time. And despite all the lockdowns, stay healthy and in good spirits.
Yeah, you too. Stay safe.